Yeah. Yes, of course. Should I bring it? Hello, hi, good morning.
Morning, Owen.
Hello, hi, Natalie, hi, Hannah. How are you?
Good, thank you.
Yeah,
Good
Owen,
stuff.
thank you.
Good stuff. Good stuff. Good stuff. Yes. Oh, great. Good stuff. Yes, yes, great. So how's it going with how are you still holding up in the holes? Everyone's still in their are you able to I mean, Natalie, how often do you go shopping, or do you take the kids for a walk, or what's your kind of breakout of the house?
Okay, Owen, my daily routine is in the mornings I'm homeschooling, and then in the afternoon I go into the office.
Okay.
And then come back, do dinner, take the dog out. That's pretty much my daily routine at the moment.
So how do you guys socially distance in the office then?
So all staff are working from home, apart from myself and my husband. We just go in.
I understand.
And I guess we're not really meant to be going in. I know that, but obviously there's just something that we need there to.
Of course, of course,
do. But as I say, we're keeping safe by doing it because everyone else is not there.
No, of course, exactly. That works. It's that works. Sorry, I mean, that's perfect. That makes sense. Sorry, let me just check in case people are waiting. Oh yes, sorry, lovely. Yes, and okay, of course, yeah. That's a good way. And Hannah, how do you do you go running, or do you have to go into work as well, or is it?
No, we've been furloughed now, all the trainees. Yeah, so we've been going, my partner and I, we've been going running every day just to get out and get some fresh air.
Totally.
No, they furloughed the trainees.
Yeah. Hopefully, I mean, I think. Hi, Dudley. Good morning.
Morning, Owen. How are you?
I'm well, thank you. Thank you. Yeah. Hopefully, I think in a month. I don't know about what you guys are thinking. Probably in a month. Who knows? I'll have to, because for how long can we? You see what I mean? It's going to be interesting.
I'm thinking 1st of June back to school, Ian.
I think so. I really think so. I think so.
Thinking though.
Yeah. With Hannah, with you though, are the trainees still getting paid though? To be.
Yeah, we still get 100% of our salary.
That's not. It's not too bad.
Yeah, no, they've given us this time, and they said they chose the trainees because they're worried that clients won't be able to pay, and obviously
exactly
will go under, and this is kind of protecting us.
Of course,
on that
100%.
And there's actually only 2 trainees because we're a small firm. There's only about 8 of us, so there's 2 trainees.
Right.
So we've just been given this time. We do Zoom calls every day, so we're in the daily meetings to know what's happening in the company and what other people are working on.
Sure.
But we've been given this time to go through our ethics.
Oh yes, of course. In fact, actually, that's true. Yes, carry on, Hannah. Yes. Because you're doing ethics Anna, on the ACCA website. It's a module, right? On the.
Yes, it is. Yeah, there's I think I can't even remember now. There's around 10 modules, and then there's an exam at the end.
There is.
There's questions during the modules as well that you have to answer.
Sorry, I've just been interrupted by these little people. Sorry, what do you want?
A pencil.
A pencil. There are 100 pencils in the living room.
No,
in the box.
No.
There's no pencil here. Go to the living room. No, please, sir. Oh, here it is. Take this one.
Yeah.
Okay. Thank you. Sorry, there are 150 pencils in my house. Is a little brown coloring pencil that's been lying in the corner of the study that she wants to use. How is that? Anyway. Sorry, Hannah. Yes, that's true. So, in fact, I guess the truth is, all of you at some point will have to do the. Hi, James. Hi. Sorry. Hi. Hope you're well. All of you at some point will have to do the. Will have to do these ethics modules. You probably 100% will have to do them before you start the. Well, even then, you still don't have to do them, but you'll definitely have to do them. I advise to do them before you do the. Before you do the case study on the strategic level or the professional level. So in a way, you kind of have time. But you're right. Yeah, Hannah's right. It's on the. It's. And they're not taught modules. You go when I say taught modules. Typically, colleges don't teach them, but you have to go onto the website and do them. So that's good in a way. You got your Hannah, like you say, you're able to use this time to get through that. So that's good. That's good. Cool. Great stuff. Let's begin. You're right. Typically my day is similar to yours, Natalie, somewhat, although I do my homeschooling in the afternoon, and then I teach in the morning, and then I take over. We've been going through yesterday. I thought I had, it's funny because I don't know, but what I will accept is that this is really, I actually thought I was a patient teacher anyway, but not with kids, because I thought that, people take time to understand, that's fine. But I was teaching fractions again. So we were going through the course, everything was wonderful. And then at the end, there was this very weird question that said something like, Jack has half a pie or something. It wasn't in context, it was out of context. Something like something was 1/4, but they kind of made the 4 bigger, so they wrote like a little 1 and they wrote the 4 big. Was 1/4 bigger than 1/2, and they made the 2 big? And my daughter looks at me and smiles and says, 1/4. And I'm like, back to school, send them, they need to go back. I'll stick to teaching adults. So let's begin. So today we're going to so James, thank you. I only picked up your mail, James, this morning. So what I've tried to do is I'm going to cut and paste the questions to you and send them to you by PDF quickly once we start. But so what we're going to do today, really, because we do have time, and I think when I say we do have time, I think we can use, what I should really say is we can use the time well to really understand what we're doing. So what I want to do is I want us to look at, I asked you, well, I'm not going to, we can always check up on that later, but the reason I want you to do question 150, like all Section A parts of ACCA exams, they give you a kind of good framework. You're thinking about the issue, you're going back and reading. The real work, of course, is in the written bits in the Section B. So we're going to, just to make the best use of our time, we're going to jump straight into the long written questions. So we're going to start with, let me just go to my screen. Don't worry, James, you'll see my screen, of course, and then what I will do is once everyone is working, I will send you I can't get the, I've asked for a PDF. I've asked, there's a guy, well, the people at Kaplan, I've asked them to send me the PDF copy, so hopefully I'll get that at some point today, so I can send you a PDF copy if your book version hasn't come through. But let me just share my screen. Okay, so yeah, we're going to page 151. Page 151, and because I'm teaching, what I don't want to do is what we're not going to do, we're going to do it in 2 ways, but the first one we're going to do it like a teaching class. So what I'm going to do is that yes, can you see the PowerPoint? Question 151? Yeah. Okay, brilliant. So what I'm going to ask us to do is to we're going to read, I'm going to ask you to kind of read the thing, and then we're going to do it in bits. So I'm not going to ask you to do the whole question before we feed it back. No, I'm going to ask you to do things in bits. So really, the first question I'm going to ask you, the first thing I'm going to ask you to do is to kind of read it and just do question A and question B, and then we'll discuss. And Yeah, I think that's it. And then discuss. And in the process, so yeah, that's the first thing I'm going to ask you to do. But what I want you to do as well in your books, and this is how you have to treat audit. You see, I think I've highlighted it several times that half of audit, you can actually pass an audit exam. Well, sorry, you can get 42 in an audit exam without, or 41 without doing any reading. You can just look at the scenario and you can come up with some relatively clear examples, 41, 42. But the test of audit is using the language that the examiner wants. So really, there is no magic pill. It's actually that easy in that if you use the answers they're giving you, because the language is the same, it's that technical. There's nothing really special really about it. It's just if we're repeating what the examiner wants, and the questions repeat themselves actually. It's a bit like accounting, like financial reporting. That's the first thing I wanted to say. Now, the second thing I wanted to say is students have asked before that, Oyen, is it important to take financial reporting, which kind of helps you understand what the standards are, how we should recognize certain elements of the financial statements before audit? Not at the foundation level. At the strategic level, yes. So, but at this level, you going through the questions will expose you to the typical balances that you need to kind of understand what the standards are. And besides, if you remember, all standards, reporting standards, when I say reporting standards, international financial reporting standards, there's big books that tell us how to report on things, IAS 2, whatever it is, we should recognize inventory at the lower of cost and net realizable value. These things are built on the accounting concepts of accruals and prudence. So really, the concepts came first. So really, you can still use the concepts to maneuver or understand how something should be recognized. And that's really the way to come through to think about financial reporting, really, as opposed to going backwards to the standards. Okay, so what I want you to do is when you're reading this question, we're going to start with this. It is there. There's a lot there. I like it because there's a lot there, and I'm using it as a teaching question. Some of the material we haven't technically covered. When I say that's the last two, where they talk about substantive testing, but that's the point. It's not about covering absolutely everything. You can actually look at it and make a good, in your own words, really look at what you would do to check something, so to speak. What I want you to do is, I want you, as you're reading it, to literally highlight and kind of, I mean, it's your textbook, literally write risk. So when I say risk, if you see there's a question here that says, the third question says, use the information, describe 8 audit risks that you would explain the response in planning the audit. So you're about to go into this place to do some work. Here is the year end. The year end is 30th of September. So you're planning, say, in June to think, okay, I'm going to be visiting this client. What are the things I want to be aware of? Those are primary that I want to be aware of, so I don't go in there and come out with maybe I've judged that those numbers are wrong, and I need to, where do I need to carry some extra testing? Where am I suspicious of something, and I need to do some extra work so that I can be satisfied that those numbers are true and fair. So I want you to highlight those risks so that when we now come to that area, after you do A and B, and I'm now going through the story, it means that when you now have to write up C, you're wondering, oh yes, I picked that up, I didn't pick that up. Now remember, the other thing about audit, which is wonderful, is that a scenario can have up to 12 risks. The question might only be asking for 6. So there will always be more risks than you want. So don't worry, you might not pick up every single risk in order. You want to try and scan through and pick as many as you can. So it's not about picking up all the risks, it's about picking up whatever they'll tell you 8. That means there's about 12, and you'll see when we look at the mark scheme. Right, okay, so the first thing I would like you to do is I'll speak to you because I can't really gauge how long it'll take to read. I mean, I'll read it, and then and that'll give me an understanding of whether I think you should have finished reading it. So the first thing I want us to do is to read this question, and as you're going, please highlight. And you may be surprised. The other wonderful thing about audit is you might see a risk that the examiner hasn't seen, and don't think, oh, that wouldn't be a risk. Look, you're the audit manager. You're the one going in there. So if you think it's a risk and you can justify it, it's a risk, if you like. So read this thing. Please highlight the risks that you see as you go along, and then when you finish reading it, answer A and B. on a Word document, and then we'll discuss A and B, and then I'll then go through this step by step. Cool. So please begin, and then I'll make some copies. You might see me doing some cutting and pasting. I'm only doing that for James so that he has access to the material. So let's go. So my hope is we do 151. I mean, when you go through these things, they do take some time, but we're still teaching. So 151, 152, and I think we can get through. I might get you to do 152 as a more bigger question where you take the time to read it and answer the whole thing. But 151 will take as a teaching question. Cool. So please begin. Yes, on 151. Thank you. I'll cut this up for James. Right, James, I've sent that through to you, so you should have that now.
Yeah, I've got it. Thank you very much.
No problem.
Sorry, William. Do you want us to do all 5 questions with this question C?
Say again, sorry?
Do you want us to do all 5 questions with this question C?
Question C.
Or I misunderstood something.
So question C says, using the information provided and the ratios, describe 8 audit risks. So your question again, sorry, Dudley, I didn't hear you there.
Do you want us to do all 5 questions or just question C?
Oh, no. Just stop at question C. No, actually, don't even start question C yet. Just get question A and B done.
Oh, okay, that's a good one.
Yes. So where are you? Are you sort of roughly made some notes on A and B?
I've picked out the 8 audit things.
That's fine.
I'll go back and double check on A and B.
Okay. Good. That's fine. And have you calculated your ratios for B?
Yes. Yeah.
Oh, brilliant. Okay, good. Thank you. That's what yes. And it's okay, please, because you're all working at different paces. But and James I've just sent him the text anyway. Hannah, how are you with B? Have you done your ratios?
I'm just doing them now.
That's fine. Please take your time. Yes, and Natalie, are you on ratios as well, probably?
Still on ratios, Ryan.
No worries. Please carry on. That's great. So once you get the ratios done, then we'll talk through, and then we'll go through the text, because I want to read the story with you and just highlight and see what you've highlighted, and then we can pick things out as we go. And James, you're probably on ratios as well, James, then?
Yeah, just going through them now.
No problem. No problem. No problem. on a second. Oh, good. It freezes that, so that won't work. Yes. Okay, so let's go through this. So what we have here is a typical case. Now, first of all, you will 100% always get a question on audit risks. Always, you will always get a question on audit risks. It's a given. It's in the syllabus. It will come every time. So what questions tend to look like is you'll always have some kind of introductory question, if you like, that looks like this here, where it says here, explain, typically some kind of general knowledge question. Explain, here we have explain the analytical, explain why, a general knowledge type question. So sometimes it might be for 4 marks, it might be for 3 or 4 marks. So just have a good stab at it, watch the time, because it's just, a couple of marks. There's more marks in the paper. So I guess the first thing, I mean, again, like I say, because we haven't finished, we've just completed planning. So we're really at the planning stage. So at least for you guys, at least you're comfortable that, okay, well, at least I know there's a planning stage of the audit, if you like. And I can imagine, again, that if I hope you're thinking that, right, well, one of the reasons I want to at least from this question, is that if I'm sitting down in June and the audit is in September and I'm carrying out a ratio analysis, it's because I want to sort of know where the issues might be. I want to compare last year to this year and look for any exaggerations and know where I should spend more time or more work on. So it helps with planning. So we can then, if you like, spread resources accordingly across all the balances. That's kind of the first thing. So you really want to investigate if there are any issues, as we will see in this question, if you like. So suddenly, if boom, this whole question talks about it. If inventory days have gone up from 1 year to the next, you suddenly want to be spending more time there. If revenue has fallen from 1 year to the next, you want to be spending more time there. It's that sort of thing. During the audit, so during the actual audit as well, we carry out, if you like, ratio analysis, or when we say analytical procedures, we're not just talking about ratio analysis, just comparing 1 year to the next and looking for increases. So generally, when you look at an audit program, as part of your work, as part of your actual analysis, it'll actually ask you to actually just calculate, if you like, the increase from 1 year to the next, just to see for yourself. There's something we're going to come and talk about. Oh no, I think it's in the next chapter. Something that's referred to. It's a very popular test. You will see me talk about it when we talk about audit tests and audit evidence, called a proof in total. Now, let me explain. I'm just going to use wages to explain what this means. And this is a very popular analytical test. We do it whilst we're working, but we can do it for every single balance. So for example, if I have 10 workers, if I had 10 workers last year, and each of them, it says on their contracts that they get £20,000 each year, well, give or take, I'm expecting to see the bill for 200,000. Now, if this year you have 11 workers and the contracts say that they should be paid 20,000, what I don't do, or if you like, what I don't do first is to look at the actual figure that's been recorded. No, I take what it says in the contract, I multiply it by the number of workers. So I'm expecting to see, if you like, 22 220,000, right? Now, what I now go and do is I actually look at what you have actually recorded. And if you've recorded 221,000, if you like, because you and I know that things happen during the year, some things might have been accrued, there might be issues, there might have been some sick pay, whatever. Then I can say, well, there's not a big difference. It'll give me an idea of how much investigation I will carry out, or how varied or how different or how far away this is from. So proof in total really says, take kind of the original sort of core figure and multiply it by the activity to see what you expect it to be, almost like variance analysis, and then compare. So we do a lot of analytical work whilst we're actually in audit. I mean, another one I used to do, just to kind of help you out or just explain, is when I typically with the income statement, when I was looking at expenses. So for example, if I look and I see that again, electricity is 1,500 this year, and electricity was 1,000, say 450 last year, and it was 1,000. Oh, sorry, it was 1,000. 1,000, and it was 1,400 the year before. I'm seeing some kind of inflation of £50. So in my mind, I'm imagining, if everything has stayed normal, that this year should be 1,550. So you can see proof in learning is sort of saying, start at almost think of it like incremental budgeting. Start at this point and then add on whatever inflation you're expecting. So this was an inflation of one person. This is an inflation of £50. I'm expecting to see 1,500. What do I actually see? If I see 1,600 or 1,800, then I'm slightly worried. So proof in total means almost take the incremental budget of what you think and then compare it with what actually happens. So we use, and this is an analytical procedure. So we use analytical procedures during the audit as well. And we also use analytical procedures at the end of the audit, if you like, as what we would refer to as the review stage, if you like. So at the end of the audit, I might ask questions like, what's happening in the market? What were we expecting to see? What does the future actually hold? What was the general growth in the industry overall? And I would compare that to my own figures that we've concluded and see if they're reasonable, if you like. And we could really do this for any balance in effect. So that's kind of the technically so this is, again, like I said, I'm using this to teach as well, because we don't tend to see this. Sometimes these questions don't come out obviously in the textbook, but doing these questions helps you highlight that every audit will have the planning, we'll go in, do the actual work, and we will review our work. Right, so those are the three stages. Hopefully, because we have time, when I say time, you're going to write this up again properly. Really, let's just audit for you. You do that and you've passed. Really, just writing up your notes is enough. Your fingers and your mind gets used to the language, and it just comes out naturally. Right, so great. So calculate three ratios for both years, which would assist you in planning. I know we haven't read the story, which we're going to do now once I get through this one, but I'm sure, and you can see it says three ratios. You could have, in your minds, picked a number and felt for yourself after reading the story that I'm actually going to pick the three I'm actually particularly interested in. Right, and what I'll do is I'll just go to Hannah. Hannah, what ratios did you work to? I mean, I'm going to see the answers. I'm just interested in the ratios you actually chose, that you chose to go for.
The gross margin.
Sure. Okay.
Then I went for inventory turnover.
Excellent.
And then I went for inventory holding period.
Okay, inventory holding period. Right. Okay, great. So these two are kind of related. I mean, it's fine. It's good that you've done them. And they could be telling you, you're right. They could be telling you, I'm just trying to get you as many marks. So you probably, once you've done either of them, did you do any more? I mean, you could have done more than three. Maybe I should ask.
No, I didn't.
Okay, that's fine. No, it's okay. That's why we're doing this, so that you can sort of see. Yeah. So the truth is that the inventory turnover and inventory holding period are very similar ratios. They kind of speak to us about the same thing. And people like them in different ways. I mean, they say exactly the same thing. It's just how you say it, right? So you're probably getting or extracting the same information from there. Gross profit margin is a good one. But and it's good because we're doing this. So I want to link. I'll link another. Not ratio, but another kind of figure that you should look at when you look at gross profit margin, because that's important. But let's look at. Let me ask a couple. Let me just go to James. Were any other ratios did you go for? That you thought?
Yeah, I chose the current ratio and the quick ratio as well.
You can see here. So again, like I say, this by doing this, we're starting to see there might be issues here. So the current ratio, the quick ratio, yes, because just because typically current ratios and quick ratios tell us a lot about cash flow. Right now, again, this is important. Again, I mean, I know it's been a while for some of you from the financial statements, but typically, if you remember, we used to classify our ratios based on profitability. Sorry, I'm just want to make sure you can see my screen, right? And you can see me writing, by the way. Can you?
Yes.
Yeah.
Okay, brilliant. Profitability, liquidity, and efficiency. So remember, we used to classify ratios in these brackets, and to a certain extent, what you want to try and do is spread your ratios so that you're looking across the spectrum to see how are there any risks to the organization's profitability? Are there any risks to the organization's liquidity? Are there any risks to the organization's efficiency? And liquidity, of course, is where we look at the current ratio and the quick ratio. And why not your auditors, the cash ratio, where we literally only compare cash to current liabilities. And efficiency, of course. So let me see, Natalie, have you gone for any efficiency ratios?
I did trade receivables and trade payables.
Perfect. So exactly, trade receivables and trade payables. So I know they only said 3, to be fair, but the question is just thinking, right, what do I pick to make my story interesting, if you like? And to be fair, the question only said calculate. It didn't ask you to do any talking, so that's fine. It just means that if you're thinking of the spread, it helps you with your discussion, right? So let's look at the. So yeah, sorry. The other thing I was going to talk about that's very important here. Is this? I think what I should do here is, Dudley, did anyone look at just revenue on its own?
Yeah, I did.
Okay, so something to highlight, something that you should do from now on. I mean, we're going to be doing this again, which is why I say audit is just about doing questions. You could be at the end of just listening to someone talk forever. Is that let's take a scenario here. That's just to kind of help you understand what's going on. Let me yeah, I will just let me just go here. Let me just erase all this. We'll just get all this out of the way before I go to the actual question. Why it's why this is important. Now, what's good about okay, all right. What's good about the oops, sorry. Sorry, where am I? Clear all my drawings. And let me go to draw. Yes. What's good about the gross profit margin, just to give you some understanding again, is this. Imagine this is year 1 and this is year 2. So that's the other thing. So be very careful about the direction. Watch the years. So for example, if this is my revenue here 100 and this is my cost of sales 60, and so my kind of gross profit is 40, so my gross profit margin is 40%. And yes, say for example the following year I have 200, and of course my 40% of that is 80. So imagine my cost of sales was 120, and so my gross profit margin as well in year 2 was 40%. So what the thing about gross profit margin, right, from a financial reporting point, from a reporting point of view in terms of profitability, is that we can argue, we can see what's happening here. We know that gross profit, like all things, is made up of revenue and cost of sales. So it tells us that yes, revenue has gone up. I mean, well, well, we can look at it closely and say, well, revenue has gone up, but we can see the cost of sales has also gone up. So this is the typical behavior of revenue and costs. This is just pure inflation, really, nothing really going on. Now, the thing about gross profit, imagine you had something that looked like this. Imagine this had remained at, let me just say this was now, yeah, why not? Let's just say this was 100. And if you like, this was 100, and therefore this was now 50%. Now, yes, you can say, wow, gross profit has gone up, but you would now have to discuss it. You would now have to kind of come back up here. You can't just say, you wouldn't just say, right, oh, gross profit margin has increased from 40% to 50%. You would have to come back up here and you would have to argue that it is because the percentage increase in revenue is greater than the percentage increase in cost of sales. That's what you would say if you were reporting on how well this company has done. Now, so on the one hand, this is all very good, but what you want to watch out for, especially as an auditor, is this question of suspicion. You see, for me, generally, when someone increases revenue, of course, typically revenue goes up, revenue will go up here. I mean, what is revenue? Price times quantity. So we've sold more, but if you've sold more, it costs more. So we expect Q, if you like, to go up as well. So just because you have more revenue, you can have more costs. So in effect, that's why gross profit margin comes in, to knock out that gas that it's just quantity. The question is really about price. That's kind of the thing we're interested in with revenue here. So this is under normal circumstances. If somehow your revenue is going up, I'm interested. I want to understand whether or not this is really the figure of revenue as an auditor. From an auditor point of view, I'm suspicious of your figure, and hopefully I'll be able to show you now as we go through the risks of why I'm suspicious. Because naturally, you wouldn't be suspicious if you're just looking at it from as an accountant, but as an auditor, I'd be suspicious generally about this. So, which is why I would always come back and just compare revenue on its own to just understand what's happened with revenue. You see, because here revenue has increased by quite a bit. So I just want to know. So yes, calculate gross profit margin, but always go back and calculate the movement in revenue from one year to the next. Always, whenever you calculate gross profit margin, and you start to see what's going on here. I know they don't talk about cash as a ratio, but you can just talk about cash itself and see what's going on. So let's look at those ratios. Let me go back to the, just because of time, what I'll do is, let me go back to let me take you straight to the answers for the ratios. And hopefully you'd have picked up all the three marks there without any issues. All right, okay. All right, so this doesn't have the, 1 second, let me just check here. I think the answers, all right, here we are, answers here. Let's just look at, I should open that as well. And that's what I will do after we go through this. Okay, so this will be early on. So let's just look at those answers to the ratios, those first two questions, and see in terms of picking up marks. So here we are, again, like I said here, and so don't worry that your work doesn't always look exactly like theirs. You are writing and getting the right answer, so you're fine. So planning stage can help us with risk assessment to gain an understanding of the entity and assess the risk of material misstatement. Don't worry, you don't have to literally, I mean, again, the practice is reading this and starting to use this language, but it's okay. The key point is, as long as the examiner can see that you know that I'm using these ratios to find out where the risks are, and you can be very practical where the risks are, what balances on the statement of financial position are at risk of overstatement or understatement. You see, just be practical and you'll get exactly the same answers. This is a mark scheme, by the way. The examiner just uses this to start their discussion. During the audit, to gain evidence as test of detail, like what you saw me talk about, proof in total, which we'll see that again and again. And finally, at the end, just to kind of conclude our work, that we are happy with the actual accounts, right? So let me just and the ratios here. So for 3 marks, hopefully you would have picked up the actual 3 marks going along as you. So 37.3, 36.4, inventory holding days. We can see here 45 to 54, or turnover. So whichever one, I think Hannah went for both, but you can see they literally said or, so they were only going to give you a mark for picking one of them. So here you can see straight away that inventory days have gone up. So we'll talk about the risks in a second. And you're the auditor, so you're not talking so much about whether the company is doing well or not. You're just talking about the risk of that balance that you're looking at. Then we have receivable days. I hope you have those numbers: 38 and 51, 40 and 58. Current ratio 3. Look at that. That's gone from 3, literally 3 to 1.65, and that's gone from 1.97 to 0.99. So we can see this is a very good ratio to have picked up on in terms of cash flow. So a risk, again, the reason we're talking like this is because there are some natural audit risks that you almost want to chuck in there. Whenever you have cash flow problems, going concern. Going concern is a risk. It's 100% valid risk. You want to put it in there. I think we're going to go there. We're going to go to the risks in a second. But I just want to highlight them like big. You put them in there straight away. I think Natalie put it in when I gave in. I did a review of one of her pieces. If you are doing, in this case, we're not. But there's still another risk, hopefully, that you might have picked up on. They don't pick up on it. It doesn't matter. You should pick up on it. If you're doing an audit for the first time, it's a risk. It's a risk. Every audit, first time, that's a risk. You get a full mark there. And why? What's your response? We're going to make sure we send experienced people in. We're going to make sure we plan properly. We're going to make sure we reduce materiality to catch all errors, if you like. We're going to carry out extra planning, if you like. And that's it, if you like. And as well, cash flow issues, going concern risks. And any risk where you think, they want to list on the stock market, or their loan is coming to an end, risk manipulation, because they want to continue to retain. And what do? Professional skepticism, clearer planning detail, if you like, review, written representation from the get the managers to sort of to sign that they are aware that there is no risk of fraud, that's not what they're planning to do, but just professional skepticism, and you get the full mark. So that you can see that language is all we're looking for in audit. Okay, let's go and read the story and just take our time. Again, like I say, when we read the story, I am teaching, so don't think, oh my God, I didn't see that. I wouldn't have picked that up. It doesn't matter. We are, that is the point of this, to do this. And hopefully we'll pick up as many risks as possible. And then we can talk about what our responses will be. So what I'll do is I'll go through it. And whenever I get somewhere, I'll stop you and ask you if you saw the clear overrides, and ask you if you saw the risk, and then you can then include that risk in your notes as we're going along. So please be writing down as I go through this. Okay, great. So let's start here. So it says you're an audit supervisor, you're planning the audit for the year end, the company develops and manufactures specialist paint and has been a client of your firm for several years. Now, I know it's not on their scheme, but this is a risk. There is a risk of familiarity. There is a risk that scope could have changed. So I'm just saying a number of things. You don't have to write all these things down, but all you need to do is write one of them or two of them. You see, there is a risk that because you did it last year, you don't think you need to prepare this year. There's a risk that the key auditors who did the work last year are gone, so you need to spend some real, or the key auditors who went out there to do it are now engaged with the people working there. There's the risk that the key people you work with there are gone, as we'll see in the organization. Right? So just because you've been doing something for a number of years doesn't mean there is no risk. So what does it mean? It means we need to go out with clear professional skepticism. It means we probably need to submit one of these for a quality review, because it says several years. I don't know. What does several years mean? Right? 7, 8, 6, 5. That's a risk right there. And that's a full mark. You have to pick it up. And that's a full mark. because a lot, like I say, a lot could have changed. They might have a new subsidiary. They might have, and this company has new products. There's a risk to us. What percentage of our fee is this thing? Right? Remember we said, bigger the fee as a percentage of our total income, right? Then that's a risk to us as an organization. That's a risk to us as an organization in terms of dependency, self-interest. We become dependent on that organization. So you're picking that up as a risk. Make a note in your textbook as your textbook, so that when you come and you see a question again like this, as soon as you see that, you've written that risk and you're done. So your response, of course, we'll come back to all of those, would be, if you like, that if they are, I mean, it's just professional skepticism, making sure that you plan the audit well, and you send a team that are not familiar, or you keep on educating your team about the need for professionalism and respect, if you like, for the client, and professional competence and due care. That is a risk. You know, audit is real life. You know, you want to, I mean, I've seen many times. I remember having, I've been, you know, people jumping, oh, hello, hi, it's been a while. And they end up talking about the football for the first half of the day. The whole Monday, 1 o'clock is gone, and you know nothing happens after 1 o'clock in many organizations. Okay, let's carry on. Okay, great. Now, this is the one I'm going to start asking you, but don't worry, like I said, where I said you don't need to have a lot of financial reporting information, but I'll talk about it and then ask you what your thoughts were, see if you picked it up. And if you did, that's great. So the first one says that during the year, they spent 0.9 million, which is included within intangibles, on the development of new product lines, some of which are in the early stage of their development cycle. So that there's a risk there. The risk here, first of all, again, we're talking about it here. Don't worry if you've not done it so much in financial reporting. Is this question of you do it within accounting as well. You and I know that people would love to debit, if you like, assets and credit back, right? Capitalize assets. It's a natural thing, right? And instead of debiting expenses, because we know expenses hit the income statement straight away. If I debit it, make this thing an asset, it means I can depreciate it over a period of time. In effect, pass through the cost gradually through the income statement and make my profits look good. So in effect, the risk here, and this is, I'm thinking like an auditor here, the risk here, and I'll talk about what's going on with this development, but one thing at least I want you to be thinking here is that whenever people are debiting debiting assets, is the risk of, well, an overstatement. That's the risk. The risk is we have an overstatement of assets and an understatement of profit, right? Because in effect, if you're avoiding putting this thing through expenses, if you like, and capitalizing it, then you are inflating your profits, and in effect, by default, and inflating your assets. It's an intangible asset. It's still an asset. I guess the question, what is new, what might be new for you, and I'll ask you in a second, is this question of research and development. So there is a standard we have. I'm talking about it now, you'll see it again. Typically, that if you're still spending time on researching something, it's not quite ready for sale. So we don't know, just by throwing money at something and spending time on research doesn't mean it's going to happen. So we expense all research costs. But once we have a point, which is pretty much required by a professional to come in, or a scientist over time, sort of say, yes, this is the point where this is now likely to sell. We have buyers. We've been testing it. It's looking good. You can start to capitalize that cost, if you like. So debit development, and credit bank. So we can capitalize it because it's going to become an asset, if you like, and then we're going to be able to if you like, use it as opposed to expensing it. So the risk here is that we will end up capitalizing some of these costs where it says early stages of their development. So this doesn't mean it's ready. We need to really see what bit is research and what bit is development. So we expense research costs, but we capitalize development costs. You don't need to even have written it as perfectly as that, but the point is that you are aware that this 0.9, we need to be careful, and the point is that you're thinking potential overstatement of capital assets and understatement of expenses. Okay, so I'm going to come to you now. What were your thoughts, please? I mean, it's just that we're online, but I want to know what your thoughts are genuinely when you saw the 0.9. I'll start with Natalie. What were your thoughts when you saw that?
Yeah, so basically I just thought about the assets and related it to the previous TYU when you said about, accounting for the assets and making sure that they haven't been capitalised when they should have been expensed already.
Perfect. Hannah, is this the first time or in a long time you're coming across research and development, or how did you tackle this when you saw the 0.9?
Sorry, could you repeat that, Ian?
Yes, of course. When you saw the 0.9 million, how did you tackle that? Is this your first time seeing research and development, or have you come across this before? Or how did you approach?
First time.
No problem. So what did you think should be done with that 0.9? Did you leave it as it was? That's fine.
I didn't do that in the question.
That's fine. That's okay. That's great. That's good. So it's good. I'm just trying to see, again, typically, which is why I say some people say, well, maybe if I'd done financial reporting, it's okay. You'll see this question again and again and again, this type of thing, especially with assets. So from an accounting point of view, so let me kind of take this again. I'll come to James and Dudley in a second. So you could have had property, just straightforward property, where people, I don't know if because I think Anna, you mentioned something about doing accounts prep. When I was doing accounts prep, definitely, especially with the construction guys, you and I know how often they would try and put as much of their kind of expenses through as capital. I saw it all the time. So your job was to kind of go through and say, well, I'm sorry, all of this here is sometimes even up to fuel. They put their fuel expenses and they'd want to capitalize that for some weird reason. They would have spent time working on a building or something, and they'd want to put in all the costs, fuel. No, I'm sorry. Cement, the bricks, and maybe, yes, of course, the wages to do with that, but they want to put everything in. So we're like, no. Here you have 10 million. You can't debit asset 10 million in credit because they're building the thing, you see. So if you're building something, of course, that's an asset in the end. But if there's a portion of it, we want to clearly separate, which is why typically when you're doing accounts prep, you would review expenses of typically whatever it is and look to pick out those things that should be capitalized and those things that should be expensed. So don't worry, this is very normal. You'll see this type of thing again and again and again. James, what were your thoughts when you saw the 0.9 million?
Yeah, I was thinking about whether making sure that they are all legitimate expenses and not.
Right. Good. Yeah, I mean, it's just fine. It's just sort of seeing. And Dudley, your thoughts as well?
Yeah, I put that it needs to be capitalised, not expensed, and obviously where the products are in the early stage of the development cycle, that you don't want to recognise that too early on and then
Good. Right. Good. So now, a standard thing I want to talk about, it's not in your question, but it's not. So naturally, when you capitalize something, and here's the thing, you cannot trust your financial directors. So from an auditor point of view, I mean, with all due respect, we trust them, but we don't trust them because so imagine now, let's just argue for the sake of it, that this 0.9 million, and I'm going to call it just plant. I'm not even going to call it an intangible asset. 0.9 million, let's just say you look through the thing and it should be capitalized. What else are you expecting, James, to see? So I've capitalized it. I capitalized it at the beginning of the year. What else am I expecting to see at the end of the year through the accounts relating to this figure of 0.9?
Depreciation.
Perfect. Depreciation. So what you'll see in a question is that typically they won't talk about depreciation. You'd go into do whatever, it doesn't matter what it is. You'll go in, you'll see because you see typically depreciation is a journal that's done at the end of the year, if you like. So it's an adjusting journal, it's done at the end of the year. But there are a number of issues here because, again, and this is what we're writing about, these are the audit risks that just come up, which is why I keep saying that once you do a couple of questions with audit, it just kind of starts to work because you see a question, they'll give you assets, you tackle it. And literally you just walk through everything. So you're thinking, okay, thank you very much. I've seen the asset, 0.9. It exists. Let's see how you recognize this thing now. Now, the question here is, you and I know that it's the financial directors who make a judgment about how long the asset will live for. It's the financial directors. There is no rule anywhere as to how we depreciate. Technically, there's nothing. And it's the directors who will decide, if you like, the I would call it, I wouldn't call it the policy anymore, but what estimate they would use, because maybe when you were studying accounting, straight line versus reducing balance used to be accounting policy, but now it's just, if you like, an accounting estimate, and it can change. It doesn't matter. Let's just call it the accounting estimate. So they might choose to go with reducing balance or straight line method. So we also want to ensure, if you like, that they have, first of all, a policy in place or an estimate in place. So there's a risk that there is no estimate in place. So there's a risk that at the beginning of the year, this thing is 0.9, and at the end of the year, it's still 0.9. That's for normal assets, property, plant, property, plant, not land, because land always goes up in value, or land never depreciates, but typically machinery, that sort of thing. We want to be checked to make sure that the right judgment has been used to decide an appropriate depreciation amount over the year. You see, the good thing about audit is if you just write and show the examiner that you're in there and you're just doing it, they'll be happy. They'll say, oh yeah, of course, they can know. You see, because now my assets should be showing 0.9 less depreciation. Now, for intangible assets like brands, you have a choice. Again, because it's a brand, you might say, well, Oyen, a brand will last forever. So what we should do is at the end of every year, we should kind of look at the brand again and see if there's any kind of, we don't use the word depreciation, we use the word amortization, to see if there's any, if you like, still depreciation. Has the brand been affected by bad publicity, or if you like, are people buying the product, that sort of thing? And we should still put a figure through, provide for something. So that's the first risk. So you can see we've got 2 risks so far. Okay, let's look at the next question. Right, sorry, I said it was a teaching question. This is really the bulk of the question, really, and let's just go through it. Then it says, additionally, as the company is looking to expand production, during the year, it purchased and installed a new manufacturing line. All costs incurred in the purchase and installation of that assets have been included within property, plant, and equipment. So what were these costs? Number 1, so basically we've gone machinery, debit 2.2, debit installation costs, and debit the 0.5 million over the 5 years. So that's the first thing. That's the second risk here. Now, I'm going to go to James first. James, I'll go in stages. Were you happy with the fact, I mean, hopefully you were, that they should recognize this? It's an asset, right? Machinery?
Yeah.
Perfect. What were your thoughts about those 3 figures? They have their 2.2, 0.4, and 0.5. Don't worry. I mean, I know you haven't done all of this yet, but just what are your thoughts?
Yeah, so I was thinking, should they all be capitalized?
Okay, good. What do you think about the purchase price? 2.2 million?
Yeah, that should be.
Good. Installation costs of 0.4?
Yeah, that can be.
Good. The 5-year servicing?
No, I didn't think that was.
Good, good, very good. So how much of that? Oh, sorry, you're right. Yes, you didn't think that should. Correct, that's right. So what would you have done? Sorry, forgive me. What would you have done with the 0.5 million?
Well, I'd have split it between the 5 years,
Perfect.
But whatever was relating to this year in the P&L.
Perfect, excellent. So you see, this isn't actually, what we've just done there is James didn't need to know any standards here. You see, the standards just culminate this. Sorry, I'm just being an accountant here. Dudley, what concept has James applied to the 5-year servicing and maintenance plan? What accounting concept has he applied? Starts with an A. Sometimes people say it starts with an M. I don't know. AC. It's okay. Sorry, I've got you off board, but it's okay. I can't see you anyway, so you can cover your head. It's the accruals concept. It's the accruals.
Of course it is. Yes.
It's okay. It's the accruals concept. Yeah. Yes. You see, we can only recognize, if you like, right, the cost. First of all, there's 2 issues here. Right, there are things we can capitalize and things we can expense. Servicing and maintenance is an expense, so you knew straight away that had to go in expenses. They shouldn't be capitalizing and take it out, and I can't recognize a whole 0.5 million in 1 year because he's only used 1 year of it, if you like. So I could only recognize, if you like, the 0.1 in my expense, so to speak. So to a certain extent, yes, you've paid for it, but you basically have an asset, so to speak, right? So you should have some kind of deferred asset, if you like. So debit expense, 0.1 million, debit some deferred asset. I would put 0.4 million. Some might argue, oh, and you can split that into two parts in the current year and the next 3 years, but I probably would actually, and credit bank 0.5 million, if we really want to be good accountants, if you like. But the key point here is we should only be recognizing 0.11 million. Right, okay, great. So, and that's kind of the story there. That's the story there. Now, again, like I've said this before, every question on an asset, we must ask the question about depreciation. You're literally getting 2 marks. Those are 2 separate marks. So every time you do an asset question, you need to ask, where's the depreciation? If you like, what depreciation policy has been put in place? Straight line reducing balance, and you want to calculate it yourself. And is it reasonable, right? Because assets depreciate. Assets depreciate. So you want to ask that. You want to ask that question there. Okay, great stuff. So that's the second one. Okay, great. I'm going to read the third one. This one is slightly harder, but when I say slightly harder, it's difficult. When I say it's difficult to see, it's one that whenever it comes up, now that you note it, you will always write it, right? So in order to finance, when I say harder, it's not harder like harder, it's just the point that you might not notice it at first, but now that I say it, you'll pick it up from now on. So in order to finance the development projects and the new manufacturing line, the company borrowed 4 million from the bank, which is to be repaid in installments over. And again, I keep highlighting this. Please, you cannot be trusting. You cannot be too trusting. I don't know. I think people are too. I think it's a good thing, but I think people are too trusting. Maybe not, maybe not. So I'm going to see how trusting you are. In order to finance the development projects and new manufacturing line, the company borrowed 4 million from the bank, which is to be repaid in installments over 8 years and has an interest of 5%. Right. So let's go to Natalie. Natalie, your thoughts. What risks did you think from an auditor point of view, or what risks did you think at all when you read this? Though, did you think there were any risks here that you would want to check?
Who have they borrowed it from?
Correct.
Bank, but you need proof, do you?
Yes, you do. Yes, you do, because I think there's an assumption somehow that financial directors, right, would go somewhere, agree a loan. First of all, this says the company borrowed 4 million, so somehow we just assume. Think about it. Who's checking on the financial director? They agree a loan of 4 million, and they agree. First of all, it says here the company borrowed $4 million. $4 million. So you want to check that 4 million. You want to see debit bank, credit, loan, 4 million. You don't want to see. You want to basically you're looking for the debit side and the credit side to see that both match. You might find that ridiculous, but you don't want to see something like debit 2 million, credit loan 4 million, right? Now you might say, well, wait, that's ridiculous. But why is it ridiculous? If you think about it, you could have asked the bank you're borrowing it from to send it to 2 separate accounts, right? Why not? You could have given them another account where they send half the money, if you like, and they send 2 million to the company account. You want to be sure that the money comes in. I've seen that before. There's this assumption somehow that all the money arrived. No, you could stash away. Remember, these are big numbers, and sometimes the bigger they are, the more confusing it is. Sometimes you see something like 35.2 million. What if he decides to only bring in 34.3 million? That's 500,000 pounds. That's not a bad sum to make on borrowing money, if you like, for the company. Remember, the financial directors are the ones who arrange these loans. So that's the first risk. We want to make sure that that's the first thing. The second risk here is the fact that the company might actually have borrowed some more money, but aren't declaring everything they've borrowed, if you like. So they might have borrowed 10 million, but they're only recognizing 4 million right now. So really kind of what Natalie said there, what you want to literally do, the simplest way is to literally ask for the loan agreement, if you like, and see the thing, inspect it. What else is it about loans that we're interested in? Typically, you did it in business studies, in finance as well. Hannah, generally with loans in general, your thoughts about loans when a company takes out a loan, what do you want to check as well, relating to the assets of the company?
I'm not sure.
Security.
Oh, sorry.
It's okay, you know, because you see, what I'm trying to get you guys to do in order is that it's literally what it is. Don't trust too much. You see, because there's no point. You see, yes, the company's borrowed the loan $4 million, but if you were a shareholder in a company and your financial director had gone out and said, listen, we've borrowed $4 million to do a deal, you would want to know, right, that if they had borrowed $4 million, how was that loan secured? You would want to know whether or not they've got the $4 million, but the entire company and your home as a sort of co-director is now, I mean, you see it a lot. A wife could be a financial director. She'd take out a loan, say she's running for the business, but she secured the loan on the house, right? And no one knew about it. So we must see the security. What was securing the house? What was securing that loan? We want to see the disclosures. We want the shareholders to know the basis on which that loan had been borrowed. So all disclosures relating to that loan have to be declared. That's the issue, the secondary issue here. All that has to be declared. So first of all, we want to check the thing exists. We want to look at the security, if you like. So like you see, my point here is, as auditors, we want to check the disclosures so that people know. That's what, if anything goes wrong, people are going to come back to us as auditors and say, listen, we borrowed $4 million. No one told us they borrowed it on, and they put the whole factory on it, that sort of thing. Right, great. So this is good. We're doing this. Don't worry. This is a teaching question, so that as you see more questions, you start to sort of pick them up. Right. The other thing here, I want to go to I'm going to give you a clue here. And this is to do with the current ratio. The current ratio. And why is this 4 million important in terms of, or let me put it this way, how could I make my current ratio look better? Think about this 4 million. What is it about this 4 million that affects my current ratio and my long-term loans? If that makes sense. I'll tell you in 1 second. Just see if you're seeing it. Now, if you remember, you'll remember this. If I take out a loan of 4 million, I will pay back some of that 4 million in the next year. That's my current liability, and I will pay the rest over the next period. So imagine it says over 8 years. I divide 4 by, so that's 0.2. So my current liability regarding this loan of 0.5, sorry. My current liability regarding this loan, right? Let me just come here. This is important again. And the reason I'm doing this is because you will see this over and over again, and you will always write it down, which is why I've said before that audit is just really a matter of picking up the points. This 4 million says that, oh, we intend to pay it over 8 years. So I'm just going to assume, therefore, that we will pay back 0.5. I'm just being general here. You see the 0.5? Really, next year, I owe 0.5. This is a current liability, and a long-term liability is 7.5 million. That's the total. So under my current liabilities, I should see 0.5, and under my long-term liabilities, I should see 7.5. So this is the classification of loans. All loans in financial accounting. I'm sure, I mean, I'll go to definitely James, Natalie, even Hannah. If you look at the notes in your financial statements when prepare the accounts, when you see the notes, the loans, I'm sure, do you remember now? Do you see the sort of 1 year, 3 to 5 years, 1 to 3 years, 3 to 5 years? Do you greater than 5 years with the liabilities in the notes?
Yeah,
in the disclosure section. Exactly. And the reason you see this disclosure is because what it does is it splits this thing up and puts this 1 year under current liabilities. You see, and this is really important because this affects, as you can imagine, our current ratio, because that's current assets over current liabilities. So if somehow I can avoid putting anything in current liabilities or avoid putting the loan bit in current, my current ratio looks good, if you like. If you like, my current ratio looks good. Okay, great. So that's that. And I mean, you'll probably forget it the first time, but so whenever you get a loan question, again, I keep saying I think the good thing about audit is there's only so many places we can go. Non-current assets, current current liabilities, long-term liabilities, equity. That's it. So once we're doing exactly the same thing over and over again with those balances. We're not doing anything different. It's just that depending on how risky it is, Right. Now, I mean, did anyone, I mean, you might have, and you might have thought it was okay. Did anyone actually calculate the interest rate of the 5% of the 4 million? I think it came to 200,000.
I didn't, Owen, but I was thinking it should be in the income statement.
Perfect. Yes, exactly. Exactly. Yes, exactly. So, but again, like I say, it's these are all the things you want to check, right? There's no way you'd walk away from reviewing or looking at what's the word? Looking at this liability of the loan without checking, have they calculated the correct interest, and has it been put through? Because think about it, right? You and I just saw, if we go to let's go back to their, okay, fair enough. They didn't give us the net profit. So we don't know. But the question is, has it been included, if you like? Is there a ratio I could talk about here? Because you can get a completely different question. Is there a ratio? Because you will probably you can get another question that tests this. Is there a ratio? Do you remember a ratio that is connected to interest?
I know it's interest over something.
That's correct. It's something over something. It's the other way around. Yes, you're right.
No, I can't think. Sorry.
It's okay. It's okay. It's fine. It's called the interest. Sorry, Dudley?
Net profit over interest.
Correct. So it's called the interest cover. So we take your interest, we take your profits, and we divide it by your interest. And we ask the question, how many times can your profit cover your interest? Now, this is a great ratio because you and I know that you have to pay interest. There's nothing. It's nothing. Which is why, Hannah, I was coming back to my question of security, because you and I know that all you have to do is miss paying your interests and the asset is at risk. So how do we test that? This question, the profit is quite healthy, although they have cash flow issues, actually. So this is again, like I say, my problem with audit is that we haven't still left the first we haven't left the first paragraph, and you've completed the 8. Like, you're close to the 8 audit risks. There's so much to write about. So your problem really with audit, you might be thinking, when you start audit, you start thinking, oh, and I don't have enough to write. Suddenly you start thinking, oh, and there's too much to write. I actually don't know which ones I'm going to pick out, if you like. And that's the skill. You just get better. So here, you literally take profit divided by interest, and then so sometimes if profit is just covered, the question here is, I guess, what is a good interest cover? That's not the issue. The question is, from one year to the next, is interest cover falling? And if interest cover is falling, then we have to ask questions about that, right? And we can actually test that. So very good. That's kind of the issue there. Okay, great. Yes, so that's another risk. So let's look at this one. This is a general risk, and let me see if you guys, hopefully maybe you pick this up. Developing new products and expanding production is important as the company intends to undertake a stock exchange listing in the next 12 months. Hannah, what were your thoughts when you saw this?
The directors could manipulate the financial.
Perfect. 100%. Perfect. That's it. That's it. Perfect. So this is very common. This has nothing to do with anything else. You don't need any numbers. You don't. That's a risk on its own, like a going concern risk. You will see this. They'll chuck it in there sometimes. You want to pick it up. Sorry, I'll just stay with Hannah and finish off with this one. I have used that expression today. What is the audit reaction, or how? What is the typical audit response to this? It's 2 words. I've used them. PS.
Oh, sorry.
Oh, sorry. What were you going to say? Sorry.
Oh, no, I don't think that was your question. I was going to say they'd be overstating, they might overstate the revenue and profit.
Yes, you're right. But the question goes on to say, what is your response? You see, the question here is, when you see this, when it says developing new products and expanding is important as a company. Once you see this, you see a company intends to undertake a stock exchange, you see, right, the manipulation, the overstatement and understatement could be anywhere. So you almost literally can't pick any particular balance to discuss it. You just have to speak generally.
Professional skepticism.
Perfect. Exactly. That's the answer. So you can see that the marks are just there for you to pick. Oh, these people want to go along and start listening. So professional skepticism. Professional skepticism just means I'm going in with my eyes open and I'm slightly suspicious. I'm very aware, if you like, generally across financial statements. I'm not taking anything at your word. I suspect you. you know, I suspect you. Yeah, right. I once had a financial director. I'll never forget. He was I thought he was a funny guy. He had put through these. They were basically they had all. They sold all these dresses. They sold dresses, but the dresses just weren't selling. So the stock just kept growing. And the sad thing, it was actually a very simple case. I don't think he needed to. So what he did was he just kept this stock room downstairs with all these clothes that hadn't sold for at least a year and a half, 2 years. And the banks, they had to pay their loans. Basically, their loan was coming to, it was December, and I was there in June. In fact, the irony was that they were a new client as well, which I thought was very odd. I mean, I know why, and I'll tell you in the end. Was because and I think the bank wasn't going to give them, they had a bad credit rating anyway, so they were trying to get an audit to prove to the bank that they could continue as a going concern, continue to trade. And so they thought that if we could get auditors to come and do an audit, sign off, if you like. And so I went in, and I just thought, I remember saying to the partner, said, oh, let's look at this. And I was like, no problem. Went in, and I looked at him and said, I think that the inventory is overstated. That's all I said. And he looked at me and said, do you think I'm a thief? Do you think I'm a thief? Do you think I'm trying to manipulate? And he was saying all the things that I had written down. And I was like, no, I don't, but it's overstated. Sorry, nothing personal. But we still signed off on the audit, just to kind of throw everything I'm talking about into disarray, because the audit partner was being paid close to 80,000, 90,000 for just signing off. I mean, 90 grand, check that out, right? So you wouldn't say no. It's scary, our world of work. Okay, great. So here we are. Yeah, let's carry on. Okay, great. So let me clear that. Clear all my drawings. Right. Okay, great. So let's now focus here on this one. It says here that the don't worry, I'll give you a break at 11 shortly. It says, let's do this one. Let's do this. This is a paragraph. So this one, hopefully you'll start to pick some of what's going on here. It says the company started a number of initiatives during the year in order to boost revenue. It offered extended credit terms to its customers on the condition that their sales order quantities were increased. Dudley, your thoughts?
Yeah, I pick up that one. I said that we obviously need to ensure that the client increases their trade receivables at the end of the year, and then to do sort of a review after the year end.
Perfect.
Okay.
Exactly. So really, we have a threat here of bad debts. The threat here is that by extending these credit terms, we would need to review. There's a number of things we need to review. We need to review your current provision for bad debts, or for doubtful debts. So that's the first big, that's the big risk. That's the real issue, to be fair, here. I mean, there's a number of other things I could be interested in. I want to highlight those, but your exam, this is enough, and you've picked out the main thing here. Yes, on the condition that their sales order quantities were increased. So you can see here, this is what I was saying earlier on here. So now I can kind of see the relationship to why revenue, if you like, has increased, because you have asked them to buy more, if you like, and then therefore, and if you go to the numbers, we can actually see an increase in revenue. We can see that, if you like. Now, there's two things I want to highlight here. There's revenue. There's another balance that, as an auditor, that is connected to revenue. It's funny because I think it's because of the way it looks, but really this word here, when we audit, we're really auditing the net revenue. It's so easy to say revenue and forget what we're really looking at, because really what we're really auditing is revenue less sales returns. Just as importantly as just as important as revenue is, sales returns are important, you see. And hopefully, if once I go through this, you can sort of understand where we're going here. So there's a number of things here that I want to highlight here, so you can see what's going on. So there's revenue. Imagine I sell say 1 million items, right? And this is the first thing I want to highlight, really important. Imagine, so that you pick it up so you know for sure. Imagine that my year end here is 31st of December, and I want to make my revenue look good. So I sell £1 million worth of goods on the 30th of December. So my revenue, so basically I go debit trade receivables 1 million, credit revenue 1 million. Now, I mean, of course, there's an associated cost of sale, but my revenue is increased, it's improved, my revenue looks good. In fact, I could have done a number of things here. I could have inflated the price. So just imagine James and I were in cahoot. I'd say to James, listen, James, I'm going to sell you some goods for £1 million. So James, you owe me here. And then James, what I would like you to do is, because you see, as the auditor, I come in and I review these. I will come in and I'll stop here. I'll say, I'm looking for revenue up to the 31st of December. And I'll say to James, listen, James, just hold the goods, please. And then send the goods back, if you like, in February, right? Or send, it doesn't really matter. Send the goods. Yeah, send the goods back in February. So I've inflated revenue just before the year end because, one, this makes my current ratio look good because trade receivables is in current ratios, is in current assets, right? And revenue here is income, so my gross profit margin looks good, but then the goods will be returned afterwards. So what an auditor will do is, first of all, an auditor will ask the question that, first of all, the key point here is this: all sales returns post or after the year end that relate, I'll repeat that, all sales returns after the year end that relate to sales before the year end have to be reversed. So you see, people typically think, and again, I'm just highlighting this, people typically think, right, that before the year end, only the sales returns that happened before the year end are included. People think, well, I mean, that's typically what you would see in accounting, right? Because it's only whatever goods have been returned that we issue credit notes for, and that's what we see here. So the sales returns that we're talking about in December might be to do with sales we made in October. But from an auditor point of view, because of this type of fraud, because it is fraud in effect, all sales returns, so these are referred to as adjusting events. All sales returns, because they clearly relate to events that happened before the year end. So all sales returns that happened after the year end, we must go back and look at all the sales returns that happened just after the year end and ask the question, do they relate to sales before the year end? Now, the truth is, of course, you might have a few, but we don't expect a large number, so they shouldn't be material, we still deduct them. So you would typically take all those returns and see if any relate, and you would adjust your revenue, if you like, for that. That's the first thing to do. That's one thing. So hopefully you're thinking about it, and you can turn this, what I'm saying, into your own language, into how you would talk about it, if you like. So this is just the idea here that they've just, here is just the risk of bad debts because they've just increased the terms. So like as Dudley said, I would look at post year end to see how much of those goods have been paid. I will look at the provision that they put in place, because typically if you increase credit terms, that provision has to increase, if you like, as well. Okay, right. And then finally, I want to do it here as well, is I want to talk about a very popular test, and I'll be talking about it over and over again, but I want to talk about it so often that it becomes part of your vocabulary. Right, and this is referred to as a cutoff test. Now, I know it doesn't have to do with this case in particular, but I want to talk about it here. So I'm going to go with my 1 million here. So this is my 31st of December. right? Now imagine I've issued all these invoices and I've actually sold goods here just on the 31st of, let's just say 30th of December. Doesn't, yeah, 30th of December, and I've sold goods for 1 million. Great stuff. Thank you very much. Now remember, I'm always, this is really important, so you see it. I'm always trying to make my revenue look bigger, right? And I'm always trying to make my purchases look less. I'm always, because I want my gross profit margin to look bigger. So I want you to stop thinking as accountants. I want you to think as auditors. How could, from an admin point of view, how could someone still claim to be honest, just sort of, remember in accounting, we're talking about periods, still make themselves look good? Right, here's the thing. Imagine I have a sale or a number of sales that happen after the year end. Imagine this is for 2 million and this is for 3 million. There's nothing stopping, and you might think, why would anyone do that? This could be 1st of January, 2nd of January. I could take proper sales invoices, if you like, right? So this sale was made after the year end. We can talk later about what is the definition of a sale. That's when goods have been exchanged, if you like, or when the goods have arrived, if you like, at the customer. But the key point here is the exam is very clear. It'll tell you that this sale has happened on the 1st, this sale has happened. Why not? I could take these invoices and I could post them. After all, they're invoices, right? I post them onto a system. I could take them and post them in our year end. Very normal. So suddenly my sales look like this, 2 million plus 3 million. So now I'm showing revenue of 6 million. Right? And sales are interesting because, unfortunately, because when I say fortunately, it's debit, trade, receivables, credit, revenue. So I've basically taken those invoices and brought them into my year. Now, as an auditor, what I do is typically a classic test is to take the 10 invoices before the year end and to take the 10 invoices just after the year end. Hello, hello, hello. Close the door. Thank you very much. No. What? Close the door. Sorry. Just say hello. Doesn't even make sense. So there's the take the 10 invoices before the year end, take the 10 invoices after the year end to check to see that the 10 invoices, the last 10 invoices before the year end, if you like, are invoices genuinely happening just before the year end, and taking the last 10 invoices after the year end to make sure they happened in that year and they have been recorded in that period as well. So you can see how people can boost revenue. This has nothing to do per se. You wouldn't see this from gross profit margin would look healthy. You'd be thinking this has nothing to do with increase in prices. No. This is really a case of me bringing forward invoices, and this is referred to as a cutoff test, and the cutoff being the 31st of December, trying to make sure that only the things that should be in our year are in our year. Now think of purchases. I could have a bill of 3 million for the 31st of December, like a purchases expense. So what I'll do is I won't recognize it in my year. I'll wait and I'll push it back into the next year. So my cost of sales doesn't look as high because I've literally pushed back purchases, if you like, one period back, right? So in that case, I want to make sure that all the invoices, that the 10 invoices, that there are no invoices that have been recorded in the next year that should be in our year, if you like. So I'm not, and that's what that sort of looking at 10 invoices before and 10 invoices after. So my main aim is to check for, if you like, completeness, to make sure that the invoices are in the correct period, if you like. So hopefully as you're hearing this, you can make it into your own language. So that was the first thing there. Right, now let's look at this next one. Again, like I said, this is literally the last thing here. In addition, they've made an announcement in October. So just think literally about what's going on here. They've made an announcement in October that they have a price promise, that they will match the prices of any competitor for similar products purchased. So if you like, they sell something, customer comes back and said, I found it somewhere for less, if you like. So in effect, they're saying, I will give you a refund if you can find it cheaper somewhere else. So customers who are able to prove that they could purchase the thing cheaper are able to claim the difference within 1 month via its website. And the company intends to include So they believe they're going to get some kind of hit, some kind of provision of 0.25, which is based on the monthly levels of claims to date in the draft financial statement. So basically, they're put through debit expense 0.25, if you like, as in people coming back to, if you like, to claim, if you like, credit bank 0.25. Let me go to Natalie. Your thoughts. What would you, what questions would you have at all? I mean, this is not a. Sometimes we get this kind. These are just a the particular scenario. So, what would you do, or what would you be suspicious, or what would you think?
I guess you'd have to check that they've recorded it. You know, I guess the evidence again, is it? Or
yes, but I mean, when I say suspicious, they've put 0.25. They've put, we believe, we expect a liability of 0.25.
It's just an estimate, then.
It's an estimate, really. Yeah. It's an estimate. It's an estimate. So in fact, it could be more.
Yeah.
It could be much more, if you like. So the truth is, what we want to do is we want to literally test it. We want to see, when I say test it, we want to see, if you like, because at least when we go, where we can see, we'll be able to see the monthly levels of actual claims to date. I mean, the records are there, if you like, which is why we tend to people ask questions like, why is revenue and sales returns not put in the same T account? Well, because we want to clearly understand what's going on here. So we want to see what's been returned, and we want to see whether or not, I mean, what if it was 0? What if it was 1 million? You need to put through an additional expense of 0.75. So in effect, the risk here is that profit is understated because you haven't put through enough of an expense. So you're always thinking, what are these people trying to do? They're always trying to do things to make sure that they don't put through, they either overstate their assets or understate their expenses. You're constantly suspicious of people understating refund liabilities, always. So what you want to do is literally test that, look at those claims to date, and see what's going on, to see whether or not you can actually trust those figures, right? I mean, again, I think over here, I think there was something I wanted to highlight here. You might be suspicious here of who can give these credit terms, who's able, you know, the controls over the credit terms. You might be suspicious. You might think, okay, listen, I want to know the controls. Who authorizes this? Are we giving too many credit terms? You know, who's checking on this? And because we have evidence, we can see straight away that cash, we've gone from, right. I'm sure you noticed. You know, they've gone from having money in the bank to being overdrawn. So they don't have as much money coming in as they did. And then, of course, you can talk about that when we come back to the ratios. You can talk about that in relationship to the ratios. You can see that the ratio days, the trade receivable days, has increased as a result of this. We can see that already. So we have enough evidence to show that, I need to be investigating this to see whether or not there's a cash flow issue. And there is a cash flow issue. It has gone from being positive to being overdrawn. Okay, great stuff. I'll give you 15 minutes. Well done. Sorry, I've been bashing you. And then we'll come back and we will do the next. We'll finish off the question, right? Okay, great stuff. See you. Come back at 11:30. 11:30. Okay, right. Let's carry on. So, right, we're almost. Don't worry, we're almost done with this. Oh, sorry. Oh, sorry. Yes, sorry. It was someone. Hey, Oyen, work has just phoned. No problem. That's fine, Hannah. That's fine. That's fine. No worries, Hannah. Don't worry. That's fine. Let me just 1 second. Yeah, let me just clear my screen. Clear all drawings. Cool, great stuff. So let's carry on with the points here. We were here. Okay, great. So now we're on this one here. It says here that the finance. Yes, 1 second. Let me just. Oops, sorry. 1 second. All right. Let me just. Yes, I'm right there. Just want to make sure that I have that there. Right, so I want to capture that point there. So it says here, finance director informed the audit manager that a problem arose in June 2008 in relation to the mixing of materials within the production process for one particular product line. A number of these faulty paint products have already been sold, and the issue identified following a number of complaints about paint consistency. As a precaution, further sales have been stopped and a product recall has been initiated for any of the specific paints sold since June. Management is investigating whether the faulties can be rectified and subsequently sold. Oh, brilliant. That's the last point. So I'm going to go to, I'll go to James. That's fine. I'll come back to you, the rest of you. Your thoughts, how would you, what were the, I guess the question is, what's the key balance? When I say key balance, what item in the statement of financial position are you interested in, at least, first of all?
The revenue.
Yes, perfect. Yes, revenue. Let me just get my pen. There is an issue there. So very good. Very good. So let's start with revenue. There's actually two. We'll go with revenue. Very good. So what's your, yeah, you're right. So carry on. So yes, you're right. You're correct. Revenue is one of them. So what's your issue with revenue first? Or what are you worried about concerning revenue?
Well, if they're going to stop selling the product, then there is none.
Yes, true. But currently, what we're more interested in is that there's a current figure. Imagine they had sold imagine they had sold these faulty items in January, February, March, April, and they had recognized 50 million relating to this faulty product. And now they've done a product recall. So you're right, there's no revenue for the rest, which we'll come back to. I'll come back to that. But for the existing revenue, because you've gone for revenue first, what about the existing revenue relating to the sales we had made in the first 6 months of the year?
Oh, well, that's going to be lost, isn't it?
That's going to be lost. That's going to be lost. So leading or driving us to highlight the fact that our revenue is very much overstated.
Mm.
You see, so I'll come back to your second point, which is just as important. So from an audit point of view here, my revenue is overstated because we have, you can see it says here that these had already been sold. So we've sold it, we've recorded revenue, but it is likely we're going to get a hit. So from a financial accounting point of view, what would I put through to deal with that hit? James, still with James. If we think, okay, we're going to get a hit, what should I be putting through? What type of journal should I be putting through? It's okay, don't worry. I'm taking you through the process. It's fine. It's good because I should be putting through some kind of.
Oh yeah, provision.
It's okay. It's okay, you see, because what I need to try and do is get you into what you would expect as an accountant to do, right? Because the question here is, I'm expecting a hit. Fair enough, it hasn't happened. I can't say I'm going to wait for all of it to come through. I'm already anticipating. So I need to be looking to see. So so from an audit point of view, right, I should ask, well, how much, right? How much, because I should ask him, it tells us it's not our entire, it says one particular product. So I'm sure you agree that I can simply go and ask, can I just see the entire revenue for that particular product? Why not? You can say, can I see the revenue or the column? Because revenue will be made up with several products. Say it's worth 50 million. Okay, great stuff. 50 million has been sold so far. And well, I'll simply ask, so how much of this have you sent letters to everyone, and how much of this 50 million, if you like, have you had to refund, right? Because it's about refunding people ultimately. And if you've refunded people so far 25 million, I expect to see that 25 million having gone out as, if you like, a sales return or refund or whatever it is. And how much more are you expecting to hit us by the end of the year? That's the first thing. So if the first balance was revenue, Nally, your thoughts, what do you think the other, given that James kind of highlighted it, what's the other thing balance therefore that would now be also affected as a result of all of
this? I was thinking about the inventory.
Yes, it is the inventory of 100%. Because you see, here's the issue here. You've spent money making this paint. Imagine you have 30 million pounds worth of inventory left, of this paint left. This is your inventory. Here it is, inventory. You've got 30 million as part of your inventory. You're selling many products, 30 million. Now, right, that we have issues because it's likely that you're not going to be able to sell this inventory anymore because it's a faulty consistency. So the question has to be, well, what are your options? What are you going to do with all this crap inventory? You can't sell it for, inventory says we must always recognize inventory at the lower of cost and net realizable value. So we can't sell, imagine we could sell this for 40 million under normal circumstances. Well, we can't sell it for 40 million anymore. We probably could get rid of it or do something with it, but it probably won't be, it probably will be less, I hope you agree, than 30 million. Maybe you can sell it off. I mean, the worst case scenario is you can't even sell it. But imagine you can sell it to people who just want to paint wood somewhere and not really do anything serious. And therefore, the net realizable value is 10 million. So I'm expecting you to put through a journal of debit, if you like, loss on inventory, or write-off 20 million, credit inventory 20 million, to bring that down from 30 to 10 million. So first of all, there's the question of revenue, in terms of putting a provision through for all the other revenue we're probably going to lose as a result of this event. And also there is a question of the remaining inventory that can potentially will potentially be sold for less than its but it says here they're investigating if it can be rectified. But I'm now aware that inventory is likely to be overstated with what's the word, with paint that we can't really sell on 21. Right, there's one more issue here, really, that I want you to just to say. I mean, any of you might have thought about it. It's not glaring at us, but it's there. I'll give you a clue. I'll just write the first letter. L.
Is it the provision for where they're saying that there'll be competitor pricing?
Let me see. Competitor pricing. Is that in this paragraph? Sorry, James.
No, they said it earlier on where they're putting.
Oh, right. No. That was just more to do with them trying to manipulate figures. Sorry, or trying to gain advantage, and they might end up manipulating. No, this is to do with, it's still in this paragraph. It starts with L. I don't want to LE. I mean, this is just a clue. It doesn't mean any.
Oh, legal.
Maybe legal issues. Legal issues. I mean, if you think about it, I mean, again, this is why we're doing this, which is why we're going through the question. The textbooks aren't going to jump out and give us the answers like this. We literally need to do the questions to pull out all these answers. This is a risk. I mean, if you think about it, you might have a legal issue. The legal issue is just a legal issue. We don't know what the legal issue is. Here we could have a legal issue where a customer could have used the paint for something else, and then, you know, they're not happy about it, and now because they've lost money on their own project, they might want to hold you partly responsible, and so you'll get you might get a letter from their lawyers. It might just be to do with a dispute, because you might say, listen, we're only going to refund you guys a percentage of what you paid. Who knows? The key point here is that there are potential legal issues. So an audit, like I said earlier on about security, when Hannah talked about assets, we are auditing disclosures as well. There is no point saying we've done an audit and we didn't know that the company had a potential lawsuit of X amount. That's no. Fair enough, it's not a number. We don't just audit numbers, we audit notes and disclosures as well. All disclosures have to be there. So we want to find out if there are any legal issues. I guess, again, I'm just pushing you. I have mentioned it before. I've mentioned the fact that it's a legal document, you might remember. How would I know if there were any legal issues? I'm just trying to push you into kind of, imagine you're walking around the building and you're trying to find out, how would I know? I mean, it's not, I'm just trying to make it as obvious as it is. You just have to kind of just say what is on your mind. That's how you would know. You can't know by magic. How would you know if there were any legal issues? Dudley, how would you know if there were any legal issues with the?
I mean, visit the legal department.
Yes. Okay, good. Start there. Yes, good. There's a very common. I'll just give you another clue, and the reason I'm doing this is because I'm just getting the vocabulary into you so that I'm going to give you. Sorry, I like this. It's okay. Don't worry. I'm fine.
Minutes of meeting.
Minutes of meeting.
Yeah.
Minutes of meeting. They're a legal document. So what you do first is because think about it, directors don't like people upsetting them and coming into their spaces, and they are powerful people. They earn a lot of money. So what you want to do is you want to try and gather as much information as you can from the information in front of you, as opposed to just going in and wait. Because every time you go into a director's room, you want to have something, you want to have a real discussion, quickly, because you don't have much time. They might not, and directors aren't hanging around all the time. They're everywhere. I mean, Natalie's talked about how wonderful they are as individuals, but typically directors they're busy people. So you will see if there were any legal issues in the minutes of the meeting, 100%. I mean, then it means that they're choosing not to. But as Dudley mentions, it's possible if they have a legal department. Now, some typically, and I'm sure, again coming back to you guys who are in practice, you will see on the front of every file, even an accounting file, I'll go as far as saying, on every accounting file, early on, you will see a company's registered address, the registered address of their bankers, and the registered address of their lawyers, typically. And what you should do as well is to send a letter to the company's lawyers. Now, this is the question here is, you should send a letter to the company's lawyers asking if there are any issues that you, as the auditors, should be made aware of. Now, again, I only say it only because it's a timing issue. Typically, the lawyers it's in their interest to send you all the information. Lawyers are independent people like we are, so they won't start hiding anything from you. So you can be sure they'll send you any documentation if there are any issues, and you'll get that telling you that And the question here is that the question here from now is really a question of how likely are they to be sued? And if it is likely that they're going to be sued, we can talk about this another time. We would either put through a provision, or if it's not likely they're going to be sued, we just need to disclose. And that's a matter of judgment, but then at least people must know. There must be some kind of disclosure. Cool, great stuff. Well done. So we've been through a number of risks there, and hopefully you've scribbled and you have a lot of things to go back and write up on. So let me just take you to the answers. Actually, yeah, no, I won't do that. This time is against me. Please look up the answers as to the audit responses and how you can respond to this, please. Apparently, it's a bank holiday next weekend. It's fine. But what I would really like you to do is you can see that you could literally, if you said, I'm going to spend the first 3 hours on Friday just doing a question, you could see that it could take you 3 hours to really do a question and do the feedback on it well. Maybe you could do 2 long questions and you would still see that it'll take you quite some time. So even if I set for you some homework to do 2 long case questions and send them to me next Friday, you'll see that it's just as rich in terms of informative before we start moving on to audit evidence. Okay, great. So let's go on to the next question. So I finish this thing and not finish this question at least. I really didn't think. I actually thought that it might take, but now this is good for me because now I can see. I'll go. I might look at audit responses, but I want to go through D and E first of all. Okay, so I just want you to really look to see this here, and I want you to sort of have a go at this, but just write down a few points. You know, don't worry, don't stress it. Just write down a few points of how you would actually go about, and literally, I hope to prove that you can get all the 3 marks, even though your answers don't look exactly like what's at the back of the mark scheme, but to prove that what you're doing is right. So now, here's the thing. I want to actually look and see. You see, so let me tell you the problem here. The problem here is that I have 40 paint products held in inventory. So I have 40, imagine they're worth 30 million. I've spent 30 million making these paint products, and they're currently being recognized at 30 million. But I, as the auditor, know that you can't sell them, and probably will have to sell them for less, but you want to keep holding them, you're at 30 million. So I need to kind of do some work to prove to you, or to check for myself and show you that this can't be recognized at 30 million. Fair enough, the standard says, you probably know, that inventory must always be recognized at the lower of cost and net realizable value. Net realized value means what we can sell it for, if you like, after fixing it. Just to give you some clues, remember that it says and just think freely. It says there that they were planning on, I think it said there that the directors were looking at, I think it said here the directors were, oops, sorry, no, it said here that the directors were looking to, we're investigating whether or not the consistency can be rectified and subsequently sold. So that's part of your inquiry, so to speak, right? So I'll literally give you 5 minutes to just read that and just make a few points, and then I'll literally talk through it just to see what your thoughts are about D, and then we'll talk about D quickly, and then we'll go on to E as well. Yes, we'll go on to E as well. So have a think about D and just make a few notes, and then and just write whatever you would have written. If you just, your focus is just on this 40 paint products and the questions you would ask, and how you would prove that it shouldn't really be 30 million. Just any questions at all. Okay, so let's talk through this and just get you, I mean, this is the first one we're doing. So this idea of substantive procedures just means, what would I actually do? If you like, what analytical procedures would I do? What inquiries would I make? What will I inspect? What invoices would I look at? What balances would I look at? What would I actually do? So just to kind of keep it in context again, I want to highlight the fact is that here, what I'm clear about is that this stock is now damaged, so to speak. So I'm ultimately trying to find out whether or not it should be recognized at the lower of cost versus net realized value versus what it holds. Now, again, it's not a trick question. If someone says to me, "Oh, Ian, something, I sell this stock regularly and it costs me," I'm just going to say whatever, I sell loads of it every time, and I've spent, or it's cost me 50,000 to buy it, and I want to prove that cost inventories should be recognized at the lower of cost and net realizable value. I mean, what should I do? What's the best way to check whether or not inventory is recognized at the lower of cost and net realizable value, by the way? What's the best test or the simplest test? When I say test, what's the way, and you sell it for 80,000, or I'll give you this hint. I actually sell it for 80,000. So this is my year end, 31st of December. So I spent 50,000 and I've sold it for 80,000. Literally, all I will do is I will literally, I literally will, there, I don't know, I can't get rid of that now. I'll leave it there. I literally will just check to see how much you sold it for. You see, because literally this is the best and easiest way to check that something is being recognized. You see, because when I sell, I go debit trade receivables, credit revenue, 80. When I buy, I go debit purchases, credit liabilities, 50. I mean, if we don't sell it, it goes into inventory, right? So the best test for checking or testing or valuing inventory, because I want to make sure inventory is always recognized at the lower of cost and net realizable value. Net realizable value means how much I'm selling it for, is I ask the question, can I see the sales invoice related to this stock? Did you sell it for more? If you did, I'm like, fine, leave it at 50,000. If you sold it for less, if you sold it for 10,000, and I'm going to be like, well, I'm sorry, you should never have you shouldn't recognize this at 50,000. You should recognize this at 10,000. So take the hit now, because inventory must always be recognized at the lower of cost and net realizable value. So that's kind of the first thing to prove. You see, because this guy doesn't want to bring it down. He wants to probably keep it at that higher value. Cool. I'll go to James first. James, any other thoughts? Whatever. I mean, again, I'm sure your answers are just as valid. So anything else you would have done to investigate these faulty paint products and see whether or not I can keep holding it at this amount, or I should hold it for less, or maybe something different?
The other thing I thought about is if you're going to rectify the problem.
Perfect. Yeah.
Any cost involved in that.
Yes, exactly. So this is referred to as inquiry. So you would inquire of management and see the process and the costs involved, if you like, of rectifying this, right? Because they tell us. So we have a good clue there. We want to see the paperwork and the judgments being made. And typically, say for example, right, if rectifying it, if someone says, remember, the net realizable value means what I can sell something for less the costs to sell it. So less the cost to rectify it. Someone says it was currently at 30 million, but if we rectify it, it'll cost us 5 million to do some work there, 2 million, and then we can then sell it for 33 million, something like this. So that means the net realizable value is now 33 minus 7, which brings us to 26 million. So now I would only be bringing it down by 4 million because I must recognize inventory at the lower of cost and net realized value. Are you with me? Or key point is we need to investigate those the process of rectification and the what's happening and what that means, and see the paperwork for the process of rectification that management talk about, if you like. Cool, great. Anything else, Natalie? Your thoughts there? What else did you write? What did you think of?
I said about the rectify, which James picked up
Perfect.
on.
Yeah.
Just any lists or documents, the actual damaged goods that may have been returned, maybe.
Yes, you see, very good. So here's the first substantive procedure you need to do: completion. So you need to actually ascertain what's left. Let's understand. So again, I'm just doing this. I'm taking it step by step and pulling the answers from you. Now I need to understand how much inventory is actually left. So you want to take the whole thing and you want to add it up. You want to actually see for yourself what's actually left, and you want to fully get. Okay, thank you. Go. I'm coming. No, close this door. Thank you so much. Close it. Thank you. Right. You want to take up all the inventory and you want to add all the faulty. You want to add all the. Sorry, let me just close this door. Okay, go into the room. Close that door. Close that door. Close that door. Thank you. Close the door. Close the door. Yes, the sun is out. People are excited. So that's the key point there. We want to get that inventory, and then we want to add the whole thing up, and then we want to then, if you like, do the valuation. We want to make sure all of it is in there. So just get it and just add it. The good thing here is, the thing about this question isn't asking us just about inventory in general. It's just focusing on this stock that's gone bad. But the key point really is about valuation. But what you were talking about, Natalie, was about existence. Does the stock actually exist? So that's kind of the first issue. Does the stock actually exist? So what I want to do here is, again, the reason I want to do this is because it means we gradually start looking at how the answers actually. Oh, chat. Oh, good. Oh, very good, Natalie. Good. Yes. Yeah. I hope that. Yes. I hope that's good, because you see, because yes, Natalie just mentioned about going through the questions. You see, that's the thing. Sometimes you are you might be. Sorry, forgive me. I'm just clearing this. It's all well and good to know theory, but audit is really about application. So the theory just kind of gets you thinking about it, but ultimately what we need to do is really see the way it's answered, really. And once you're there, because you can see it's long, the theory is a lot anyway, so you could spend all day just reading. You don't want to get a headache, but you want to start applying it straight away. So let me take you straight to this bit here. We'll come back to this bit here. So this is the faulty inventory. Let's see some of the things that they are talking about. And so you can clear old clear old drawings. Okay, great. So what do we have here? So each of this is a mark. All you need to do is have picked one. So first of all, this is about existence. Obtain a breakdown. So this is the thing. This is why I'm going through this. You see, because I generally life is like this. If there are certain words that we use in audit, right? That just kind of we just use them, and it's only by practicing. So if you're ever looking for a list, if you're trying to understand, to test something, it doesn't matter what it is. If someone says go along and look at non-current assets. Do they exist? the first thing we always say is, well, obtain. Now, you could say get, but we don't say get. The language is the same, which is why audit is technical. Obtain a breakdown. Just get a breakdown of the, like we said already, like what you were saying, held in inventory, and just check to see that, if you like, that it's complete, or if you like, that it's all there. Confirm its accuracy. Now, I mean, they've gone through a bit more detail, which is just as good. But this is, I just want to go through the ones that you told me, just to show you that, if you like, you said discuss with management. Discuss. That's all you can see. So we're discussing about rectification, the current status of their plans for this product line, and whether they're able to rectify and sell the goods. If so, agree the cost of rectification to supporting documentation. You might not have been this. Your language might not have been this. Pretty, but it doesn't matter. Key point is that you're highlighting that I'm looking at the cost of rectification in order to really calculate net realizable value. If the damage has been recognized and sold, agree the sales invoice to assess net realizable value with the new cost of the product. So let's look at a few others here. Agree the cost of damaged goods to supporting documentation to confirm any overheads, raw materials. Okay, so this is when we go through inventory, something that you will, when we go through testing inventory, because this is just to pick up on a few things. When you're making inventory, right? You will remember from management accounting, you have direct materials, direct labor, and there must be an overhead, if you like, assigned. If you remember, this overhead was usually based on some kind of apportioning, some kind of production overhead, spreading it. So there's a judgment here involved. And this is a standard cost of making an item, which is considered the value of the actual item. So you can see that a lot of judgment goes into even deciding what the cost of a product is. So we're not talking about buying and selling products, of course, because then if you were just buying and selling, it's just the invoice, right? I bought 10 items of shoes. I bought 10 shoes. So therefore, it's easy. But when you're actually making products, you can see the amount of which is why they're asking you, really check to see, just confirm that this figure, the actual figure they're claiming it to be, you're actually almost adding all this again and checking to see. Here they're kind of going a bit extreme, which is kind of the same thing here. They're saying, listen, if discuss with management if the goods have been written down. If so, follow through the write down to the inventory valuation to confirm. So you could have said, oh, listen, they're writing down the thing, and therefore we will write that off. Let me clear all drawings here, and then push up a bit to see a number. All you needed was 3 of these. And again, you can see here they've said inspect monthly board meetings to obtain further information regarding the paint and its possible resale value. So a number of things, and this is just a guide. The key point is what you're doing is sort of thinking, is this figure what they say it is? Should it be less? What attempts are they making to, even in this, you could have put any legal, you could have put, are there any legal issues here? What is the breakdown of this cost? What percentage? This one in particular is the kind of thing you hopefully will be coming back to after we've done more work on inventory here, where you're really now going in. So where it talks about, here, from the breakdown, agree the damaged goods quantities manufactured since June. So you're really showing the examiner you understand that, okay, from here to here, I'm focusing on these items here. This is where all the faults were. And then from June onwards, if you like, these ones were good, these ones were fine. Or what were the bad products since June? You're just going in, you're trying to focus, you just want to get all the damaged goods together in one bag and ensure they exist, find out if they have to be written down or if written off, or if they're going to be rectified. Pretty much that's it. Right, okay. You see, because the thing is they might be understating them anyway. We still have to probably reduce them, but we just want to know what that value is. Okay, great. So that's that. Now let's go to the last question, and I'll talk through that. Practice question here. Let's talk through that. This is a question on revenue. revenue. I've already mentioned a little bit about the issues here with revenue. Yes, I've already talked about revenue a little. And let's see what's going on here. So first of all, let's see what happened here. So this was our revenue, right? Revenue went from 16,990 to 19,850. So that was quite a big jump. I think it was about 37%, although gross profit margin stayed roughly the same at about 36, 37%. So gross profit margin had stayed roughly the same, but revenue seemed to have increased by quite a bit. I mean, there's been an increase in cost of sales as well. We can investigate that, but let's look. It says, describe what procedures I would do. So this is just in general now, and I know we haven't done this, but this is a good chance to just kind of put our feet a little into looking at substantive procedures for and looking for evidence for revenue. So this question wants us to look at revenue. I'm going to talk through this just because you haven't done it, but I've already started mentioning a few things. So looking, I want to see, I want to prove, I want to know, so you can understand. I want to know whether or not this figure here is what they say it is. This thing here, 16,990. That's the first thing that I want to do. Now, I guess the first thing that I would do, again, so that I do it, I want to do it step by step, so you can always see it, and when you just think about it. Someone is telling me that their revenue for the year was 16.99 million. Now, the truth is, I just even want to know, first of all, whether this even happened. Did this even happen? Right? Did this occur? Did this occur? I know I'm going to be doing audit evidence soon, but you see, let me explain something again so you can see what's happening here. Revenue, all these events, all these things, revenue and cost of sales, right? These are movements. These are flows, right? They're flows. It's like income. I mean, but these actually exist. You can physically touch inventory. You can touch the invoices. You can touch the money. So here is the actual existence of the assets here and the liabilities. These are flows. These are changes in profit. So there's no test of existence of revenue. It's just that the revenue happened. And it's not a silly question. The question is, if I want to know if revenue, I want to first of all know, did it even happen? First of all. Now, if I want to know if revenue happened, right? Not a silly question. I'm going to go back to the beginning. I'm going to go back to the sales order. So a sales order would have come through, if you like. We would have delivered the goods. Once we delivered the goods, we would have sent out a sales invoice, and we would have received some money in the bank. That's the system. That's what I'm expecting to see, if you like. Because you might think, oh, that's ridiculous. Why is that ridiculous? You can have people set up fictitious sales invoices. Why not? And put them through. So I want to know if this thing even happened, first of all. So my first task is to prove occurrence. And I guess to prove occurrence, what I need to do is, over the 12 months in the year, what I want to do is I want to pick invoices over the 12 months. Doesn't matter, take a sample, literally. And in most organizations, you might see, typically at least most organizations, you should see, before you can put a sales invoice in, I'll go to Dudley here. Typically, you would see a sales invoice, and then you see the goods delivered note and the sales invoice all kind of together, and sometimes they get stapled or they're in the same folder. Is that when you're sending an invoice to any of your clients? I know you're in services, Dudley. Is there a similar sense of wanting to see, before you put a sales invoice in, wanting to see the sales order and there's a goods delivered note and a sales invoice, or how do you?
There's no. So I suppose you'd say a sales order would be a client signing a contract with us.
Yes.
Then obviously the contract is reviewed by one of the managers.
Sure.
The payroll manager will then implement it, so they'll create an account, X, Y, Z, and I'll check it.
Exactly. Okay. Perfect. Exactly. So sorry, and that's something else. So when we come to actually look at evidence, really, a lot of what I'm saying here, it looks as though this is happening every day as it is, as kind of what Dudley says. We have clients who are already set up on the system. So typically we now have standing data with the client already on the system. So we just automatically generates an invoice because the client is already on the system, if you like. And of course, within that system, there's set credit limits, the addresses are there. So it just pushes out the invoice. And until when the client pays, we see that showing in the client account, and we would restrict anything selling to them until they have paid or whatever it is. So we literally would take a sample, but we still go old school, and we take that sample, and like you say, we walk back through and literally make sure, and go all the way to the bank. Now, of course, I expect 100% to see the sales I make in January, February, March, April, May, June, July, August. Of course, I won't post year end. I will see the sales I made in December and November post year end, right? But that's fine. It still doesn't mean, I mean, I can still trace or follow. I can still follow a system. I can still follow a process. So first of all, I just want to know if it even occurred. Now, the next thing I want to do is I want to just see, first of all, whether or not this is the full amount. Now, the truth is with revenue, again, this should help you with I want you to naturally understand this. It is unlikely that a client will understate their revenue. It is unlikely. I mean, unless they didn't want, people say things like, well, Owen, what if they don't want to pay as much tax as possible? And I accept that. But it doesn't matter. You'll only be deferring. Yeah, I guess. But it's not really the issue. Typically, people are trying to overstate their assets. So really, it's not really the case here that people are trying to understate revenue, so to speak. So what we tend to observe is that people tend to overstate revenue. So we test, if you like what I was saying earlier on about this question of the cutoff. I want to make sure that only revenue for 2007 is in the year. I don't want revenue for 2008 in the year. I don't want it, if you like. So the second thing I want to do is I want to make sure that any invoices, so doesn't matter, I will take like the example I gave you, I will take a sample of sales invoices after the year end. Typically that's enough. You could stop there. I guess you could argue that I'll take a sample of sales invoices, because definitely sales invoices within the year will be in your year, because you're not really testing for understatement. So I know you're trying to, anything before the year end, I'm sure you would like it to be there. It's invoices, or no, actually, no. I will look, yes, the test is take a sample of invoices before the year end and take a sample of invoices after the year end to make sure that only the invoices for your year end are in your year. Because, as I was saying, forgive me there, that you might have put in invoices before the year end that shouldn't be there, and they should be in the following year. So I will test, if you like, check all these invoices here to make sure that you haven't tugged in the next year's invoices in our year. That's the next thing. So so first of all, I mean, I guess the first thing is I will first of all see if it's occurred, and then I will add everything up. So typically, just by looking at the computer system, because we're all using a lot of computer systems now, the argument is that you could bring everything into Excel and add everything again, but the systems typically, generate the sum. So typically we can just look down and we can actually look at what's happening. So that's generally your big picture approach first. Your big picture approach first, to just see the totals. Now, I mean, even when I've taught financial accounting, one thing I've always done is I've always highlighted that any good financial performance paper, when you're analyzing ratios or you're doing ratios, that you won't, Any good question? So for example, this question, someone says, well, what's the gross profit margin? You would just say, okay, 6190 divided by 16990, and I'll do the same thing here, 7410 divided by 19850. The truth is that these ratios on their own are actually quite useless. They don't really help us with much. And I'm sure you know that if you remember what used to happen with financial accounting. Now, in any organization, I mean, in reality, because the truth is that you and I know that revenue, typically you're not selling one product. And even if you were selling one product, you're selling, prices are changing and gross profit margins are changing over different periods. Usually you are selling a number of products. You're selling a number of products. So what you want to do, in fact, what you have to do, just think about it. Now you're being a tool, you're being a real practitioner. You're going in here, you see 16990 as a total. You're like, this is rubbish. Can I see a breakdown? And you will see a breakdown, whatever. Maybe here we have 1,000. Here we have 5,000. Here we have 8,000. Whatever, and then we'll have 2,000 and whatever the balance is. And I will have exactly the same thing for the previous year. You see, so here I might have 800 and here I would have 4,000. So I can actually compare like with like. So when I was talking earlier on about the use of ratios during the audit, if you like, because I can actually calculate, and in its related cost of sales, I can actually calculate revenue with revenue for each product, if you like. I can actually calculate revenue and gross profit margin for each line for myself. And then, if you like what I said earlier on, calculate a proof in total. Maybe I can see, and remember when you do the set of breakdown, it tells you, okay, you sold 5,000 items here and you're selling them for £1, if you like. And here it might, and here it says that you imagine it says you sold 5,000 items here and then you're selling it for, I don't know, whatever. If I'm expecting you to sell 5,000 items again, so I just do the 5,000 times, if you like, whatever, £1.20, if that's the plan, and I see that there's a change, then I'd investigate and spend a bit more time, if you like, on those differences. But ultimately, what I want to do is I want to do a breakdown of revenue and investigate each of the product lines separately and compare using analytical procedures. Analytical procedures doesn't mean, it just means I'm comparing prior year to my year, what happened last year, to my year, to investigate any variances, if you like. You see, because this will help me with my cutoff. So first of all, like what I was saying earlier on, maybe I should have said this first, where I do take the breakdown. But I don't know, people do it differently. It doesn't matter so much. You can start from the big picture and then understand the big picture, get a total. Okay, you've got a total, and then you might do a breakdown. It doesn't really matter. But these are the kinds of things that we are looking at with revenue. Right, so that's just the sort of a foretaste into the key tests here. The big one I've walked through. This is called a walkthrough. I start from sales order to bank. I do, if you like, a cutoff test to make sure that only the revenue for that period should be in that period, if you like. Because I'm trying to be sure that this number is truly, they assert this number to be 16990, and I want to be sure it is. Okay, great. So let's look at what let's just look at what the answers look like, just to give you a sort of feeling, because we'll come back to it. The question, of course, is an exam question, so in their minds you'll finish the syllabus, you see. So don't worry if we haven't done audit evidence yet. Right. So let's go to that question. Right, so let's look at them. And I think they wanted 5 marks. So there's always going to be more than you wanted. So let's just look at it. So you can start getting a sense of the things we can expect. So the first one here, I mean, again, there's a number of things we could have done. Let's just say, compare the overall level of revenue against prior year and budget for the year and investigate any significant fluctuations. Now, this, of course, we would have done this at the planning stage, I would imagine, to be fair. But I'm happy to accept it again. I'd be surprised if we hadn't done this at planning. So I don't know if I'd go in again and do it, look at prior year to budget. We probably have the results of this already. But obviously, I just want to understand. In fact, we did that already, didn't we? We said, okay, it's increased by 30-something% to the because if we compared that 2007 to 2008, so we can see here that okay. There seems to be something going on here, and that's how we found out the information about them extending the credit periods. This is what I was saying here. The next one, perform a proof in total. So what I was saying here, calculation for revenue. So creating an expectation of the average price multiplied by the increase in sales volume for the year. So I'm just going to do this again just to kind of highlight what this means. And it's a very popular test we do in practice. A popular substantive test. Now, again, like I said, I'm selling 1,000 items at £5. So we believe that we will sell 1,100 items this year. Maybe the prices stayed the same. So I believe, therefore, I expect to see 5,500 as revenue for that particular product. And then you can see this expectation should then be compared to the actual revenue. So maybe it's 5,000 again, and I want to understand, why is there a fluctuation? If you like, why is there a difference? Because based on last year, based on an incremental process, and we do this for every balance, doesn't matter, wages, revenue, purchases. What's my expectation based on how many units did I buy last year? What's the expected inflation? Just like we would do a budget, right? Just like we would do a budget. Yeah, let's go. So let's look at some of their other answers. So yeah, so what I was saying here is it tells us to get a breakdown for the main product categories and compare to the prior year for any unusual management. So all you saw me doing was now going in a little, and so everything, all these are very kind of common. And you with time, like I said, there's only ever going to be one revenue. So by the time you do another question on revenue, you'd be saying all this type of language. Take it, compare to prior year, look for significant fluctuations, discuss with management. Get the gross profit margin, compare, look for any significant fluctuations. But again, this is just guiding you. Select a sample of sales invoices and agree the sales prices back to the price lists. Okay, yes, to ensure the accuracy of the invoices. Actually, there's a number of tests here that I actually just didn't mention, because I was gonna, when we now come into looking at revenue, just verifying invoices. Actually, you see, because there's an assumption here that just because the data if it's standing data, then it's about the controls of a standing data, so discounts shouldn't change. So just validating whether or not those invoices themselves are correct or are true, right? We just want to be sure that we just want to test the controls over the invoices. We just want to know, if you like, just to see that. So for a sample of invoices, just calculate discounts again and sales tax. These are just general tests in general. You take a sample throughout the whole year. Credit notes, I think I mentioned earlier on when I was speaking, that when we talk about revenue, we're talking about revenue, and we're talking about revenue less credit notes. So you say take sample credit notes and check to see that they've been removed from sales. This is what I was talking about here. Take a sample of customer orders and agree this to the dispatch notes and the sales invoices to ensure they've all been put into the system, and to inclusion into the sales day book. and the revenue general ledgers to ensure completeness of revenue. So really, again, like what I was saying here, we want to be sure that all the revenue that's happened actually occurred, really. And this is also testing for completeness. But typically, we would see, because because people are typically trying to overstate revenue, I expect revenue to be complete. I'd be surprised if you didn't put in all the revenue. I mean, if you didn't put in all the revenue, that's just bad controls, right? Because one, trade receivables are less and revenue is less. Why would you want to do that? I mean, it's possible. This test really rings true when I deal with purchases, right? Because that's when people wouldn't imagine. You have a big batch. I've seen it before. Big batch of purchase invoices sitting on a table in December, not being put through, right? And that's the issue here. But with revenue, it's likely you're going to put everything through. In fact, it's likely you're going to put the ones for next period in our period. This is what I was saying here, this one here. Select a sample of dispatch notes, both pre and post year end, and follow these to the sales invoices to ensure that the cutoff period has been correctly applied. So the question here is, will someone, if you like, if goods that were dispatched post year end, of course, those sales are made post year end, is it likely that we would see those in our in the correct accounting period? And I'll expand on this, but hopefully you can see the relationship between a dispatch note and a sales invoice. Think about it like this: goods dispatch note, 2nd of January. Sales invoice, I want to be cheeky, I'll put 31st of December, right? So I think I mentioned that I was going to come back to the definition of when is something truly a sale. So something is truly a sale when it leaves us and arrives in the hands of our customer, not when we choose to generate a sales invoice, because the customer might be none the wiser if I send him a sales invoice dated the 31st of December and he gets the goods a couple of days later. He doesn't really care. For him, he's got his goods. But I'll say to the auditor, oh, my sales invoice is dated 31st of December. The system would recognize it in this period, when really it should be recognized in the next period. So it's really important to map for this cutoff. It's the goods dispatch note that will help me truly tell whether or not when the sale was made, and therefore it should be recorded on that date. Right. Again, a number of things. Again, there's a lot of them. We only wanted 5. So please read through these. Please kind of sit and take your time. What I want to recommend is, I want to recommend doing one question a day. Just generally just writing it up. It takes a while to read anyway and to understand. And you could send me a sample. It's a public holiday next Friday, but what I really wanted to say was, I wanted to set for you questions. Maybe the next, definitely 151. I wanted to set for you. This is 151. I wanted to set for you 152. Question 153. Question 153 and 154. Please definitely send these for our class next Friday. We don't have a class just because it's a public holiday, and I'm respectful of that. Somehow, a number of public holidays have fallen on a Monday. I'm sorry, not on a Friday. There's Good Friday, then there's this one again. So definitely, please, you can just wake up and just do 153 and 154. They're good questions on audit risk, and send them to me, please, as homework for next week. So you can practice 152 during the week and write 151 up again, keep it in a file, and then do 153 maybe on Thursday, or 154 on Friday, and send to me. And then we can carry on. So what that means is the following week, and I'll try and get you to do some more during the week anyway. So whatever, 155, 156 during the week, and then we can jump into audit evidence on the 1+14 on the 15th of May. On the 15th of May. Cool, great stuff. Is that good?
Thanks, Owen.
No worries. Great. No worries, guys. Good stuff. Have a good weekend.
Owen, just a quick one.
Yes.
Do you have any vast work? Do you have any sort of copies of final audit reports for businesses. If not, it doesn't matter. It was just be interesting to
yes. So
entirety
you're right, exactly. So I haven't before. This is the good thing. Typically, because of the pressure on the course in terms of the time, I've never really been able to sit and get that. But now, because we have a longer course, my plan for you is that in 2 weeks when we meet, I'm trying to send you, prior to that, I'll send you, my plan is to send you a file, an audit file, to actually get you doing some kind of general testing for me. The plan was to do it in class. There you go. I will put some kind of audit file together for you. Especially, I think this will all come much more alive when we start doing the actual evidence, looking for evidence and doing testing. Talking about audit evidence and audit carrying out the actual testing. So we will spend May just looking at evidence and looking at the different balances and looking at the pro formas that you would ordinarily fill out when you were going out an audit and literally pretend to do it. So that's my plan anyway. So you'll have a good chance to really get your hands kind of in there. I'll try and get some information and put that together. Cool. Great stuff. Awesome. Great stuff. Nice one, guys. See you later. Have a good week.
Thank you very much, Owen.
Thanks, Owen.
No worries. Thanks. See you later. Bye-bye.
Bye.
Bye-bye.